Hello everybody, thank you for watching my video. I am so excited to bring you this video today. These are my new setups. I've made a few videos of my setups before, but now my setups are really distilled down. Even a professional could use them and follow them. So I'm very happy. So let's dive in. So I just made the video and it's a really good presentation. It turned out really well, but it is slightly longer than I wanted it to be. So if you're going to watch any part of this presentation, watch the third page. That will be, if you skip to around 8 minutes and 15 seconds, it'll be that one. It's the third slide. The fifth slide is also really good, so that's about 16 and a half minutes into the video. So yeah, if you watch any part, watch the presentation on the third page, which actually has my setups and criteria for my first and main setup, and then the fifth slide, which has my setups and criteria for my secondary setup. Thanks for watching. So this is the first page of 5 of my setups. So it starts with that note about the most important part of the day is just the bias. Not losing sight of the market structure, of the hourly candles, the 30-minute candles, just maintaining that bias and having an idea of where we are, who's in control. This is essential because if it's a range day, if no one's in control, or it's just very choppy, we won't have an idea of how to execute, and we shouldn't be trading. We have to just be disciplined and work within the context of the market structure. The next thing is classify the day before it starts. So END, it's just easy to remember that way. E-Day is like expectation. I think something's going to happen today. Maybe it's non-farm payrolls, maybe it's interest rate decision, CPI, something like that, where we expect a lot of price action. Or currently we're having the wildest volatility since the 2020 COVID crash. Even though there's no like major news today, I would still make like most days today an E-Day, just simply based on the fact that there's crazy volatility and that's likely to continue. N day is just, I don't know what to expect. Could be volatility, could be just choppy range, stuff we don't want to trade. I still approach an N day similar to an E day. And then D day is like down day. I expect it not very much to happen. Usually I'll put a day like this after maybe a huge move, or if we're in the middle of a consolidation. If we're in the middle of like a longer consolidation that happens on the daily time frame sometimes, that could be like a D day, but there aren't very many of those recently. Then X just means no trading at all. So back to the first point, determining bias. What's the overall trend doing? Where's the prior day high, prior day low, prior day close? Those 3 levels are the most important levels, and using those, determining where you are inside of that, outside of that, that will be really critical. You can expect, if you're in a downtrend, you can expect sellers to be above the prior day high. If you're in an uptrend, you can expect buyers to be below the prior day high or prior day low. Yeah, so just like, and if you're inside, are we in an uptrend or a downtrend? Are we in a range? Should I not trade if we're in a range? Are we consolidating? Just asking questions like that. So yeah, it's up, so you can just read it, but I'm gonna go to the next page now. Okay, now we're on the second page. This is where we start getting into the meat and potatoes of my setup. So start of day, this is the most important time, but sitting out doesn't cost you a thing. So if you're unsure, just wait. The 30 minutes often has like some range activity, so just be careful. There will probably be a pullback, or maybe it'll just range the whole time, or some type of reversal. So just being very careful, that's really important. Yeah, and it's up, so you just read everything there. But I just want to hit on the most important points. When not to enter, this is directly from Adam Grimes, directly from the Art and Science of Technical Analysis book. Don't ever fade a simple support or resistance. Never fade a rapidly rising or falling market. And then no trading inside of a range unless that range is part of a structure on another time frame. So like some consolidation. A range on the 5-minute could be like a consolidation on the 30-minute preparing for a breakout. But if it's just ranging, we do not want to trade that. Entries, always wait for the candles to close generally. 99% of the time you should wait for the candles to close. But if we're bullish and there's an area where we've got like 3 wicks up, and all the wicks go down to the same level and bounce off of it, you can put an entry order there. And I say wait till the candles close to make the order, but we can still do limit orders. Like oftentimes the right thing to do is wait for the candle to close, and maybe you expect it to come down a tiny bit before it goes up. Enter a limit order. Limit orders are a good thing to do. I have a bit about strong volatile markets, where you want to put the stop, and then for normal markets, the execution is more challenging. We have to execute perfectly. This has been a problem for me in the past, where I correctly identified the direction the market was going, but I did not execute well. So in the next couple pages, page 3 and page 4, which are the most important pages of this presentation, that's where I'll get into the real, what to do when, how to do it. Then practical advice for doing the right thing. This is something I struggle with because it feels a bit unnatural, but I'm trying to start doing this. Just talk out loud, have a conversation with yourself. So there's a bunch of prompts there about what you can talk about with yourself. But we just want to look at like mainly real quick, just objective data points. Where are we in relation to the moving averages? How is the market behaving today? Is it have a direction? How volatile is it? How erratic? How many wicks are we seeing? Or is it moving normally? Or is it ranging? What side is in control? Just talking out loud, asking questions like that. We don't want to overcomplicate it though, so going back to the first and most important piece, just forget everything, keep it stupid simple. Who's in control? What side is controlling the market? This is the third and most important page of this entire presentation. Why? Well, because we actually cover what my signals are. So we've talked about the context, what we like to see. We've talked about how to make good decisions mentally, make sure we're being objective and disciplined, just through like that talking exercise, and how to identify bad times we don't want to trade. But this is like the most important, because when the market is good, this actually tells us how to get in. So we have the market context at the top. This is what we like to see. We like to see a stronger move in a direction. We like to see a decline against that. We want to pay attention to how fast that happens. Like, if it happens really fast, it means that the move up was probably erratic and it's not a real move anyway. And in that case, that means maybe that's actually a pullback, and now you want to join going the other way. Maybe, I don't know. But yeah, we want to see a strong move one way. We want to see it pull back. We want to see it come down to around the 15-minute 9 EMA or the 5-minute 21 EMA. And around there, that's when we want to join. And we want to either wait for like a Like if we want to go long, if we see strength to the upside and we see like a flag down, it's okay to buy the close of a flag to the downside. But we want to have a tight stop loss. We don't want to have too much size because that's a more aggressive entry. For the second entry, after it comes down, once we see it come up and show strength to our direction, that is when we want to enter, and we can put the stop loss just below that candle. So that's the second entry, and that's the more like confident entry. The first entry is more aggressive. Another thing we want to see around the 5-minute 21 EMA or the 15-minute 9 EMA is just a doji candle, because that, if it pulls back, like it makes a flag, and we see, you know, doji, usually around the third or fourth doji if we're in the first. The earlier in the day, the faster this will happen, the more aggressive it'll happen, and that's why there is some context. We do want to use the 9 EMA on the 5-minute if we are in the first hour and it is more aggressive, we can take that aggressive entry. But a lot of this is just dependent on each day. Each day is different. No moment is the same. Every moment is unique. So, but just using that 15-minute 9 EMA, that 21-minute, or that 5-minute 21 EMA, that's crucial. And within the context of we have a strong breakout and it pulls back and we're expecting another move in that direction. So everything I said that applies to both the long and the short side. It's super simple, but what it is it's actually defined. It says if you see a pullback to this level, to this moving average, buy it and put the stop loss, and you can buy that with a limit order. You can buy that like if it's a very strong market and each bar we get a strong breakout bar, a pullback might just show up as a wick down in a 5-minute bar, and typically it won't go below the bar below it. So if you're longing, if you're going for a trade to the upside, you see a strong close, that's our second entry. We could buy the close of that with a market order, or we can place a limit order, entry order, like halfway down that bar and put a stop loss below. It just depends on the market context and how fast everything is happening. You can buy the close of that stronger bar and put the stop loss halfway. But yeah, we want to ideally use limit orders, but in the first 60 minutes of the day, first 90 minutes, moves a lot faster. Market orders may be the better option. All right, now it is setup 2, which is the breakout. So we have some, just like the last one, we have some market context. It's a bit longer, but there is a lot of similarities. We talk about the main difference is we want to see more consolidation, because in the last setup, which is my preferred and go-to setup, this setup is kind of like the first break of that. And this setup is pretty much just for like the first 30 to 60 minutes of the day. It can take longer, but breakouts we want to look to happen pretty quickly, like even first like 15 to 20 minutes. So we want to see, well, you know, I'll just let you read this slide. So pause it if you want to read. I want to get into the next slide, which is similar to the last slide. Talks about the actual, like, what I want to see. So I'll pause it here and move to the next one. But if you want to read this important context, pause now. One very important piece, though, I will add, is this does not work on range days. On range days, 80% of breakouts fail. This is meant to be on a strong day, after maybe a day of consolidation, where a day we expect support and resistance to be violated, an expectation day, as I said earlier. So it just has to be done on the right day. It's really important to get the context right with this trade, because if you don't, you'll be going for breakouts that fail and you'll just be getting chopped up. All right, let's go to the next slide. All right, final slide. And these are my stupid simple rules for the breakout. So same first four bullet points, just to keep them in the front of the mind. So what we like to see with this is a gap up near or above the prior day high. We want to see consolidation near the 5-minute 21 EMA, 15-minute 9 EMA, just like on the last setup. We want to see this happening near the upper resistance or above the upper resistance. This trade is sometimes called a coil because you'll see it coiling up. It's like the tension is building in the spring, and then it just gets unleashed, and it can move pretty far. So unlike the last trade where there were a few different confirmation candles, you can buy the close of a bar going against you, and then there's also the confirmation close up for you, that you can buy, or you can just buy a doji if there's like a little micro range. This one, we want to see strong conviction. It's more selective, basically. We still have the bit about you want to buy it near the moving averages, but we want to wait for a bar that maybe tries to break out one, like against the prior day high, like goes below. We want to wait for maybe a failure of that and a hammer up, or we want to see a breakout up above that holds. And when this happens, we just want to buy the close of that, because then it can really move fast. So that's would be a market buy. There is a thing called an oops reversal. One way to think about an oops reversal is like, say it opens up prior day high and it goes up, but it closes not very strongly. It makes a big wick up. Then we might think, okay, maybe this is going to try for another breakout long, which we want to be. That's the main thing we want to go for, is breakout to the long. But if there is a wick up, we should probably just wait a little bit and see what happens. Maybe it'll move down, and if it crosses the open or the prior day close, different people say different things, but I think crossing the open or prior day close is probably the best, the two best criteria. But if it crosses that the other way strongly to the downside, then we do want to sell. And this is where the market context is really important, because if we're in a bear trend, if we're going down on the daily and it gaps up and it goes up off the open, but there's a big wick up, just think of that like a pullback. Like setup one, we like to see direction one way, pull back against, and we buy in with the expectation that the people that brought it up the first time will be there to support us again. This is kind of like that, but without the first step. Like instead of seeing instead of seeing like confirmation in the direction, the market structure, we see it just starts with a pullback. We just see it failing one way, and like that failure is actually confirmation to go the other way. But this is very dependent on this trade is very dependent on the market structure, on what the hourly is doing. Looking at the pre-market charts and seeing hasn't been consolidating. Pre-market shouldn't matter too much. What matters the most is what happens the day before. We want to build the thesis based on the day before. But we will know, going into the day, like where the price is approximately going to open. But yeah, we just want to see acceptance. It's more, and we want to see it around the 15-minute 9 EMA, the 5-minute 21 EMA. So I'll end this video now. These are my stupid simple setups. I'm not focusing on reversals. I'm not focusing on range days. I'm not focusing on mean reversion. I'm just focusing on pullbacks and breakouts, but mainly pullbacks. If I miss a breakout, it's fine because I can probably just go for another pullback. The big thing is making sure it's supported by the market structure, being selective, and then when the trade appears, you actually take it. And it's just great to see. It's good to try and buy at the moving average. If it comes down, if we're looking for a bullish setup and it comes down and closes below the 21 EMA on a pullback, buy that close. Maybe it'll go up. If it doesn't and it just goes down, it fails, but you have a close stop loss, it's not a big deal. Say you buy that and it does start coming up, you can add a little bit. If it does show, the next candle shows strength to the upside, that can be your first entry too. Or say it comes down, it closes strong, it goes down just slightly past the candle, it stops you out, but it stays consolidating a bit. Just try a second entry. Buy that doji, put the stop loss below that. Maybe it'll go up from there. It won't always be like a just one-way quick movement. So yeah, that is my setups. Appreciate you watching. Let me know what you think. And yeah, thanks for watching. Peace.